Denmark should not be wealthy. Welcome everyone to today's exploration of one of the world's most intriguing economic success stories. At first glance, Denmark seems like it should be struggling. It's a small country with harsh winters, virtually no oil reserves, and taxes that would make most economists cringe. Today we're diving deep into the Danish Paradox. How does a country with some of the world's highest tax rates continue to thrive while other nations struggle with debt and stagnation? What makes Denmark different from its Scandinavian neighbors? And more importantly, what can the rest of the world learn from their approach? Denmark presents us with a fascinating case study that challenges everything we think we know about taxation, government spending, and economic growth. While most economists would predict that sky-high taxes and extensive welfare systems would crush competitiveness, Denmark has somehow made it work. Their companies dominate global markets, their citizens enjoy incredible living standards, and their economy remains remarkably stable. But this isn't just another feel-good story about Scandinavian socialism. Denmark's success comes with real challenges and important limitations that we need to understand. From housing costs to immigration pressures, the Danish model faces serious tests that could determine whether this approach is truly sustainable for the long term. Let's start by understanding just how unlikely Denmark's success really is. This is a country of fewer than 6 million people, roughly the population of the state of Arizona. It has no significant natural resource wealth like Norway's oil or Sweden's vast forests and mineral deposits. The climate is cold and often harsh, hardly ideal for agriculture or tourism. Yet despite these apparent disadvantages, Denmark consistently ranks among the world's most prosperous nations. The numbers tell an incredible story. Denmark's per capita GDP exceeds that of many much larger and seemingly more advantaged countries. Their unemployment rate remains consistently low, their currency is stable, and their government debt levels are among the lowest in Europe. Perhaps most remarkably, Danish citizens report some of the highest levels of life satisfaction and trust in government anywhere in the world. To understand how this happened, we need to go back to Denmark's transformation after World War II. For most of its history, Denmark was indeed a poor agricultural country, relying heavily on farming and fishing, while its larger neighbors industrialized rapidly. By the early 20th century, Denmark lagged significantly behind countries like Germany, Britain, and France in terms of industrial development and overall wealth. The turning point came in the post-war period when Denmark made a crucial strategic decision. Rather than remaining an isolated agricultural economy, Danish leaders chose to embrace globalization and European integration. They joined the Nordic Council, the European Free Trade Association, and eventually the European Economic Community, which later became the European Union. This integration gave Danish companies access to massive new markets, allowing them to scale far beyond what their tiny domestic economy could support. At the same time, Denmark began developing what would become known as the Nordic Model, a unique hybrid system that combines free market capitalism with extensive social welfare programs. The foundation of this system rested on a simple but powerful idea: invest heavily in people and they will drive economic growth. Denmark made education free at all levels, including university and vocational training. They implemented universal healthcare, ensuring that medical costs would never bankrupt families or force talented individuals out of the workforce. They even invested heavily in seemingly small things like bicycle infrastructure, recognizing that healthier, less stressed workers are more productive workers. But perhaps the most crucial element was their approach to taxation. While Denmark does indeed have very high tax rates, the structure of their tax system is what makes it work. Unlike many countries that rely heavily on corporate taxes and payroll taxes that discourage hiring and investment, Denmark shifts much of its tax burden to individual income and consumption. Corporate tax rates in Denmark are actually quite reasonable at 22%, below the average for developed countries. This makes it attractive for businesses to invest and expand. Meanwhile, the high personal income taxes and 25% value-added tax ensure that the government has sufficient revenue to fund its extensive social programs. The system also includes what economists call flexicurity, a unique approach to labor markets that makes it easy for companies to hire and fire workers while providing strong safety nets for those who lose their jobs. Unlike countries with rigid labor laws that make companies reluctant to hire, Danish businesses can adjust their workforce quickly in response to changing market conditions. When Danish workers do lose their jobs, they don't fall into poverty. They receive up to 90% of their previous salary for up to 2 years, along with comprehensive job training and placement services. This means workers aren't terrified of losing their jobs, and companies aren't afraid to take risks on new hires. The results of this approach are visible in Denmark's remarkable success stories. Take Novo Nordisk, the pharmaceutical giant that has become Europe's most valuable company by focusing on diabetes treatment and weight management drugs. Or consider Maersk, the shipping company that handles 14% of global trade. These companies didn't succeed despite Denmark's high-tax environment, but because of the educated workforce and stable business climate that those taxes helped create. Denmark's early investment in renewable energy provides another compelling example. While most countries were doubling down on fossil fuels in the 1970s, Denmark made an unusual bet on wind power. Today, that investment has paid off spectacularly. Denmark now generates over 50% of its electricity from wind power, far ahead of most other developed nations. More importantly, they've exported their expertise globally, with Danish companies like Vestas becoming world leaders in wind turbine technology. But Denmark's success isn't just about smart industrial policy or tax structure. It's also about something much harder to quantify: trust. Danish society has remarkably high levels of social trust and confidence in government institutions. This trust didn't develop overnight. It's the result of decades of transparent governance, consistent policy implementation, and a political culture that prioritizes long-term thinking over short-term gains. The benefits of this high-trust society extend far beyond tax compliance. Danish companies can operate with lower transaction costs because they don't need to spend as much on legal protections and verification systems. Workers and businesses cooperate more effectively because they assume good faith from their counterparts. Denmark also benefits from remarkable income equality. The gap between rich and poor is among the smallest in the world, with Danish CEOs typically earning about 60 times the average worker's salary compared to nearly 300 times in the United States. This equality isn't just morally appealing, it's economically beneficial because it creates a large middle class with significant purchasing power. However, we need to be realistic about the challenges facing the Danish model. The system works partly because Denmark is small and relatively homogeneous. With fewer than 6 million people, most of whom share common cultural and historical backgrounds, it's easier to maintain the social consensus necessary for high taxes and extensive welfare programs. Geography also helps. Denmark sits in the heart of Europe, surrounded by wealthy trading partners. Nearly 70% of Danish exports go to other European countries, providing stable markets for Danish goods and services. This is very different from countries that depend on volatile commodity exports or distant trading relationships. Immigration presents perhaps the biggest challenge to Denmark's future. Since 1980, virtually all of Denmark's population growth has come from immigration. While this has helped fill labor shortages in crucial sectors like healthcare and construction, it has also strained the welfare system and raised questions about social cohesion. Studies suggest that some low-skilled immigrants have higher unemployment rates and lower tax contributions than native-born Danes. This has led to uncomfortable debates about the sustainability of Denmark's generous welfare system and has pushed the government to make benefits more conditional on employment and integration requirements. The aging population presents another significant challenge. Like most developed countries, Denmark faces the prospect of fewer working-age taxpayers supporting more retirees. Healthcare costs are rising, and pension obligations are growing. This demographic shift will test the resilience of Denmark's welfare state in the coming decades. Hit subscribe to be notified about new videos released each week. Perhaps most importantly, Denmark is maintaining its commitment to education and innovation. They spend almost 6% of GDP on education, keeping their workforce among the most skilled in the world. They invest over 3% of GDP in research and development, making them one of the most innovation-driven economies globally. So what lessons can other countries learn from Denmark's success? The first is that high taxes don't automatically destroy economic competitiveness if they're structured correctly and used wisely. Many countries make the mistake of taxing businesses and payrolls heavily, which discourages job creation. Denmark's approach of keeping corporate taxes reasonable while relying more on personal income and consumption taxes may be more effective. The second lesson is the importance of long-term thinking and investment in human capital. Denmark's decades of investment in education, healthcare, and infrastructure have created a highly productive workforce that drives economic growth. Countries that focus only on short-term fiscal savings often underinvest in these areas and pay the price in reduced competitiveness over time. The third lesson concerns labor market flexibility. Denmark's flexicurity system shows that it's possible to provide strong worker protections while maintaining business flexibility. This approach may be particularly valuable for countries struggling with high unemployment or rigid labor markets. However, we must also acknowledge the limitations of the Danish model. The system relies heavily on social trust and cultural homogeneity that may be difficult to replicate in larger, more diverse countries. The model also faces ongoing challenges that test its sustainability. Immigration, aging populations, and global economic volatility all pose serious threats to Denmark's high-tax, high-welfare approach. The Danish experience also highlights the importance of social cohesion and institutional quality in economic development. Trust between citizens, businesses, and government may be just as important as specific policies in determining economic outcomes. This suggests that countries looking to reform their economic systems should pay as much attention to building institutional capacity and social trust as to adjusting tax rates or regulatory frameworks. As we look to the future, Denmark's adaptability may be its greatest strength. The same pragmatic approach that helped transform Denmark from a poor agricultural country into a modern economic powerhouse is now being applied to contemporary challenges like automation, climate change, and demographic transition. Whether the Danish model can continue to thrive in an increasingly complex and interconnected world remains an open question. But for now, this small Nordic country continues to punch well above its weight, offering a compelling example of how smart policies, long-term thinking, and social trust can create remarkable prosperity even in the face of apparent disadvantages. Denmark's story reminds us that economic success isn't just about natural resources, geographic advantages, or population size. Sometimes the most important factors are the ones that can't be easily measured. The quality of institutions, the level of social trust, and the willingness to invest in people and their potential. In a world facing unprecedented challenges, these may be the most valuable lessons of all. Thanks for watching.